Hello, my name is Brent Foster, founder and CEO of Northbound Wealth Management. Welcome to our annual State of the Markets presentation. We are delighted to have you all here today and look forward to sharing some important information with you. I'd like to draw your attention to these disclosures. Please take a few moments to review them and let me know if you have any questions. Before we start, this is just a reminder to please silence your cell phones. I'm here to help you better understand what happened in the markets in 2021 and what may unfold in 2022. If you have any questions during the presentation, please ask by emailing me at bfoster@northboundwealth.com. Chances are someone else is wondering the same thing, so if anything comes up, ask away, and I'll answer those questions in a follow-up blog release, which will be posted on our website. Today's agenda. Today, I am going to focus on 4 key questions. Number 1, how did stocks perform in 2021? Number 2, what drove market performance in 2021? Number 3, where are we now? And number 4, what do financial experts forecast for 2022? Now, let's begin by looking back at Wall Street analysts' initial predictions for the market performance in 2021. How stocks actually performed last year and some of the factors that drove that performance. With multiple COVID-19 vaccines announced in the latter part of 2020, Wall Street analysts were cautiously optimistic about 2021. While the US wasn't out of the woods at the time, there was a number of reasons to be hopeful for a strong economic recovery, including multiple vaccines to stem the spread of infections, fiscal support, monetary accommodation, and a budding reopening. As you can see from the actual results, the market performed better than even the most bullish analysts could have hoped. For instance, JP Morgan was the most optimistic of analysts on this list, calling for about a 20% increase from 2020 closing levels. Even that prediction ended up underestimating where the market closed out 2021. Next, let's talk about some of the factors that led to this. After a bumpy start to the year due to a slow vaccine rollout and political uncertainty, the stock market climbed steadily higher throughout the year with a succession of better than expected quarterly corporate profit results and a strong rebound in economic activity. However, the climb was not without its hiccups, as the rise in the Delta variant infections in the third quarter, accelerating inflation, and worries over the Fed's tapering plans led to short-lived pullbacks. In the following images, we'll discuss each factor separately and in more detail. First, though, let's take a look at how these factors affected stocks over the course of the year. What happened in 2021? As the chart shows, you see a steady move higher throughout 2021, except for some periodic dips, the worst of which was a retreat in September and concerns about the economy and Fed policy peaked. The S&P 500 index is generally considered representative of the US stock market. Keep in mind that past performance does not guarantee future results. Individuals cannot invest directly in an index. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. Without going through each of these dates, let's take a look at a few noteworthy points. As you can see, the market was choppy during the first quarter of 2021, but take a look at mid-March, where the US crossed the mark of 100 million vaccinated Americans. At this point, the sense was beginning to grow that the nation had overcome the fits and starts in our vaccine rollout. Investors began to feel more comfortable that the country was finally getting to a place where the economy could sustain its growth momentum. There were scares throughout 2021. Look at the middle of July, and more broadly, the month of September. The one-day slide in July and the nearly one-month retreat in September were largely attributable to COVID-19 related events. We saw the stock market resume its climb in October based on the strength of strong corporate earnings, a decline in COVID cases, and an upbeat report from the Fed. Markets turned volatile into the close of the year, slumping on news of the Omicron variant the day after Thanksgiving and testimony by Fed Chair Powell that he was considering accelerating the bond taper and contemplating more rate hikes sooner than anticipated. Higher inflation and an improving labor market were cited as reasons to justify accelerating monetary normalization. The market closed out the year with the Fed announcing some decisive steps on monetary policy that may very well likely impact the markets into 2022. We'll discuss those more in detail later in the presentation. Despite the pivot toward a less accommodative monetary policy, stocks climbed higher into year-end as the Omicron fears receded a bit. Corporate earnings are one of the primary determinants of stock prices over the long term. As the chart indicates, corporate profits came roaring back from their 2020 pandemic levels, lifting investor sentiment. Earnings soared in the second quarter of 2021, posting a 25% year-over-year jump in corporate profits. However, the third quarter results may have been even more impressive since the 17% growth in earnings was during a wave of the new Delta variant infections. Investors were especially impressed that the spike in infection cases did not diminish consumer demand, that the companies were able to maintain their profit margins amid rising inflation and supply chain challenges. The economy staged a strong rebound in the first half of the year, as evidenced by the successive increases in GDP. However, growth moderated in the third quarter due to a rise in COVID infections and a growing bottlenecks in the supply chain. While many observers anticipate a re-acceleration of GDP expansion in the fourth quarter, continuing supply chain problems may prove to be a drag. Labor markets were slow to benefit from the economic reopening of the first half, but as you can see, the unemployment rate dropped sharply by the end of the third quarter. As we entered into the last 3 months of the year, the labor market and outlook continued to improve, with job openings exceeding the number of unemployed and robust wage growth. Inflation developed as a real concern as the year progressed, rising from a modest 2.6% in March to 5.4% in September, with October and November 12-month inflation rates setting an even higher bar. We'll examine this development a bit more in depth a bit later. Consumer sentiment was on an upward trajectory as American consumers felt better about the economic reopening and safer with the rollout of an effective vaccine. However, it flagged amid a surge in Delta variant infections at the start of the second half of the year. The fourth quarter number is the actual sentiment reading for November and reflects a continued downward slope in consumer outlook due to rising inflation and the perception that policies have not been put in place to arrest the rise in prices. Finally, home builders' optimism was especially high in 2021, not surprising given the low interest rate environment and the continued consumer demand for homes amid the pandemic. The number indicated is a survey of single-family home builders with their view of economic conditions and their 6-month outlook. Scoring on the basis of 0 to 100, you can see how high their optimism was throughout the year, notwithstanding a dip in the third quarter, owing to that quarter's resurgence of COVID cases. So where are we now? So we've looked at some of the factors affecting market performance in 2021. Next, let's look at where we are now and examine the headwinds and tailwinds that could affect the direction of economic growth and financial markets in 2022. To create some context about where we stand today on various factors, let's start by examining where we stood just before the pandemic began. After a stretch of good economic performance, conditions in February 2020 were mixed, though still positive. You can see a number of positive indicators, including monetary policy, consumer spending, interest rates, and perhaps most notably, inflation and energy. There were some cautionary signs about the future, such as the economic outlook, equity valuations, leading economic indexes, and corporate profit growth. The only two factors of concern were geopolitical risk and the domestic political environment at the time. Now, let's fast forward to November 2020. By then, we appeared to be beyond the worst days of the economic lockdowns and COVID cases. The overall outlook was cautious. While monetary policy, inflation, corporate profit growth, and leading economic indexes were trending positive, there were more cautionary signals, most significantly in consumer spending, energy costs, business sentiment, and labor market weakness. There was also double the number of negative indicators from February, most notably equity valuations and disposable personal income. Now let's review what these financial and economic indicators tell us about today's current state. As you can see, 17 of the 20 indicators are green, which suggests that the economy and markets are in a good position in 2022. Only 3 are flashing some warning signals, such as equity market valuations. After the run-up in values in 2021, this shouldn't be a big surprise. There are no outright negative indicators here. Let's delve a little deeper into one of those speedometers, the Leading Economic Index, or LEI. This includes 10 components ranging from stock prices to manufacturing orders. When examined together, this data may give a clearer picture or view of where we are. Leading economic indicators suggest that economic expansion is trending higher into 2022. Though supply chain bottlenecks cannot be overlooked as a factor that may frustrate this outlook. As you can see, a rise in the index of leading economic indicators has never been followed by a recession, so that's encouraging. However, no model is flawless, especially with COVID still hanging over the global economies. It's important to remind people that past performance does not guarantee future results, but as we review charts like these, history can help suggest where we are at in the economic cycle. It's also important to remember that forecasts are based on assumptions and subject to revisions over time. Financial, economic, political, and regulatory issues may cause the actual results to differ from the expectations as you see them expressed here. From the leading economic indicators and the economic speedometers, we just saw that the economic outlook is looking positive for 2022. However, the economy and the financial markets will have to withstand some potential headwinds to meet these optimistic expectations. The first headwind may be the emergence of Omicron, the latest variant of the COVID-19 virus, along with the resurgence of the Delta variant. While few expect the sort of economic shutdown that accompanied the 2020 pandemic, given the progress of vaccines, any moves to restrict social contact may adversely impact economic growth, similar to the Delta variant surge last year. Inflation remains a big challenge for the economy, as higher prices may sap consumer spending power and consumer confidence. We will take a deeper dive into inflation's implications for the market later in the presentation. We may also see rising yields as bond investors look for higher yields to compensate for rising costs. At the end of last year, the Fed announced that it would be quickening the pace of its wind down of its monthly bond purchases and signaled that as many as 3 to 5 rate hikes might follow in 2022. The Fed's policies have been a major factor in driving stock prices higher or lower over the next 6 to 12 months. However, the Fed is looking to return to a more normalized monetary policy amid a healthy economy, a rebounding labor market, and accelerating inflation. It is uncertain how investors will react once supports are removed and interest rates move higher. We saw an example of this at the beginning of the year. Think back to January when the minutes from the Fed's December FOMC meeting indicated that the rate hike might come sooner than expected, which led to a sharp sell-off. The results of higher rates may be a revaluation of stock prices to reflect higher interest rates in the future. I believe we saw a repricing with the correction in January of 2022 based upon the Fed's pivot to rising interest rates. However, if the Fed finds itself behind the curve in fighting inflation, it may be forced to use its monetary brakes, which could adversely impact markets. As 2021 came to a close, there were early indications of slowing economic growth in China, in large part due to its zero COVID policy that shut down whole cities at the first report of infections. As its wealth has grown, China has become an increasingly larger importer of foreign consumer goods and raw materials. Any reduction in demand will be a drag on a wide range of companies globally. The midterm elections also create a degree of uncertainty. The markets will be looking to see if there is a shift in congressional power and what that may mean for future economic policies. Finally, geopolitical tensions are always a political headwind. Tensions in countries bordering Russia, China's threats towards Taiwan, and Russia's leverage over Europe's energy supply are just some examples of where tensions may flare. Tailwinds. The economy is expected to expand in 2022. The level at which economic growth serves to propel markets higher, of course, will be a function of how healthy that growth is. Heralding one of the most hawkish policy pivots in years, the Fed said last Wednesday that it would double the pace at which it's scaling back purchases of treasuries and mortgage-backed securities to $30 billion a month, putting it on track to conclude the program in early 22, rather than mid-year as it initially had planned at one of the meetings last year. It's difficult to anticipate the full impact of the Fed's pivot towards interest rate normalization, but we should anticipate more volatility in the stock market as it digests the pace at which the rate hiking cycle progresses. As communicated by the Fed in its last meeting, it is indicated to raise rates 50 basis points in March as a liftoff point. Corporate profits were solid in 2021. As mentioned earlier, one of the primary determinants of stock prices over the long term is corporate earnings. Provided earnings continue to expand in 2022, this may justify current valuations and serve as a catalyst for higher prices. Of course, past performance does not guarantee future results, and return and principal value of stock and prices will fluctuate as market conditions change. Also, the consumer appears healthy as net worths have grown from pre-pandemic levels. Financially strong consumers should continue to support further consumer demand for goods and services. That said, there is one important caveat to this tailwind. Customers or consumer confidence is actually at a cycle low owing to the sharp and continued rise of inflation. Watching the cost of basic consumer goods like food and energy take up an increasing amount of personal budgets is not only psychologically dispiriting, but it could reduce the amount of discretionary income consumers have at their disposal. There is another side to what inflation may do to the consumer spending numbers. Inflation may increase spending in the short term since behavioral experience suggests that consumers frequently choose to buy today if they believe that prices will be higher tomorrow. Despite this kernel of uncertainty regarding the consumer, we expect that consumers will be a net positive force for propelling economic expansion. After all, we are in a consumer-driven economy. Equity values. Before we move on to our discussion of 2022 forecasts, let's examine this chart to see where prices are trending against historical averages. The most common way to do this is to look at the PE, or the price to earnings ratio, which measures what investors are willing to pay for a company's earnings. If you look at the dotted line in the middle, you can see that the PE for the last 25 years is, on average, 16.8. You can also see that the PE moves quite a bit, with a peak during the dot-com boom and a trough during the credit crisis. As of October 2021, The PE was about 21.4, which is higher than its 25-year average. It may bear mentioning that the big technology stocks, which because of their growth prospects typically sport higher PEs, represents a greater proportion of the S&P 500 than ever. So a comparison to the past may have limited value. These higher valuations may also be in line considering the current low interest rate environment that we've been in for a long time. Forecasts 2022. We've talked about what impacted markets over 2021 and what may impact markets this year. Now let's see what the experts have to say about where they think the market is headed in the context of a more detailed discussion of some of the possible headwinds and tailwinds we just finished reviewing. We mentioned that a healthy consumer might be a tailwind for the market this year. Here's why we think that could be the case. The share of GDP that comes from spending from within the US is just a shade under 70%, which means the financial health of the American consumer is key to economic growth. This chart is an illustration of Americans' balance sheets coming into the new year. As you can see, assets owned by individuals have steadily risen since the depths of the pandemic in the second quarter of 2020 to a level that is now higher than pre-pandemic levels. Meanwhile, consumer debt has stayed roughly the same through this same time period, owing in part to government assistance programs throughout the pandemic period. When taken together, Americans' net worths have increased, which has put more spending power into the hands of consumers, which may lead to higher economic activity. There is one other important element to increase spending, however, besides having the money to spend, is confidence about the future. In the past 2 years, we have seen that consumers who lack confidence in the near-term health of the economy or are concerned about the spread of COVID infections are less likely to spend. Consumer confidence took a hit as 2021 came to a close, thanks to the Delta surge, accelerating inflation, and the introduction of the Omicron variant. Corporate earnings will be another likely important determinant of stock market performance in 2022. After all, these are a key factor in determining stock valuations in the long run. Overall earnings in 2021 were strong, rebounding strongly from muted earnings during the pandemic months of 2020. As you can see from the chart, the third quarter was exceptionally strong, increasing 39.8%. Fourth quarter 2021 earnings growth is expected to be over 20%. These are big numbers that are not expected to be repeated. In fact, earnings growth estimates are expected to narrow with 2022 calendar year growth rate of just under 9%. At first glance, this may seem like a headwind rather than a tailwind for the markets. But remember, markets are discounting mechanisms that look 6 to 9 months out ahead. Today's prices reflect the 2022 forecast for corporate earnings growth. However, a strong economy in 2022 could lay the groundwork for positive earnings surprises in 2022. It's important to remember that forecasts or forward-looking statements are based on assumptions subject to revision and without notice and may not actually materialize. And if we've learned anything during the past couple of years, it's that the outlook for financial markets can change quickly. Inflation is an important economic indicator. Rising prices impact the entire economy. Too much inflation can hinder growth, while too little inflation can be a sign of economic weakness. As this chart illustrates, inflation took a sharp turn higher last year from the norms of recent decades. The strong rebound from the pandemic-induced recession, coupled with labor shortages and supply chain bottlenecks, caused the prices of many goods and services to jump. Some economists also point to the combination of fiscal spending and accommodative monetary policy as contributing factors to the acceleration of inflation. Whatever the reason, inflation has accelerated at a faster pace and persisted for far much longer than originally anticipated by the Federal Reserve. Fed Chair Powell has admitted as much. Despite this admission, Powell still believes inflation will recede in 2022, and the market has largely accepted this inflation narrative. While unclogging the supply chain pipes will be a key development in 2022 to moderate inflation, wage growth pressures are likely to persist as a driver of continued inflation in the new year. We also included the rise in the producer prices because this can indicate future increases in consumer prices, since businesses often pass on some or all of their price increases to the consumer. Inflation may have a major influence on the performance of financial markets in 2022, since it could force the Fed to quicken the pace of its bond tapering program and change its plans for interest rates. In each instance, the Fed's actions may impact bond yields and stock prices. Even if the Fed sticks to its schedule for tapering and interest rate hikes, the bond market may not sit idly by. Bond investors may demand higher yields to offset rising inflation, the effects of which could ripple into the stock market, especially among high valuation companies. During the past 2 years, there's been no greater influence on the stock market, at least on a short-term basis, than COVID-19. Increases in infections raise the prospect of economic restrictions, causing temporary sell-offs, while declines in infections or new treatments buoy investor sentiment. With the emergence of Omicron and the prospect of an uptick in new infections, investors will be particularly sensitive to how well this risk is managed. As the chart indicates, we've seen defined surges of infections, the initial one in 2020 and that of the Delta variant in the third quarter of 21. Of course, no one can predict the course of COVID-19 infections moving forward, but we have seen that markets get nervous when they spike. Economic forecasters surveyed by the Philadelphia Fed are painting a generally improving economy. While they have trimmed their GDP growth estimates for the final quarter of 21 and the first quarter of 22, they are projecting stronger growth in the second half of 22 than originally anticipated. On the labor front, they are very optimistic, calling for declining unemployment rates throughout the year and at a much faster pace than they had earlier predicted. Unemployment and wages. The labor market continued to strengthen over the course of 2021, with unemployment falling and wage growth accelerating. As we saw on the previous slide, unemployment is expected to fall further as the economy expands. A healthy employment picture has historically argued well for the economy. While wage growth is generally a positive development for the economy, it should be noted that this upswing in wages has been offset by a faster rise in prices, leaving many workers with lower spending power despite strong wage growth. So what are the experts forecasting for domestic equities in 2022? On average, they are expecting a modest gain from the 2021 close. The forecast reflects the belief that stocks are unlikely to repeat their outsized gains of 2021, as well as some headwinds that may impact corporate earnings and economic growth, such as inflation, supply chain disruptions, and the potential for new COVID-19 variants. Within this average forecast for modest returns is a broad range of estimates, from a flat or slight decline to a much healthier gain. Of course, no one knows for sure what equities will do in 2022, and predictions at this stage are just that, predictions. However, these analysts' perspectives show that for the most part, Wall Street is guardedly optimistic. Like other images in this presentation, this image includes a forecast. So it's important to remember that forecasts are based on assumptions and are subject to revisions over time. Financial, economic, political, regulatory, and in this instance, health issues may cause the actual results to differ from the expectations expressed in the forecast. We've covered a lot of information, focusing most of our discussion on what drove the market and what we expect to move the market over a short period. However, as we know, we can sometimes get lost with short-term focus on the market is a consideration of the long term. This chart illustrates the value of investment discipline. Since 1950, we can see that the one-year range of returns for stocks is quite wide, with yearly gains of up to 47% and yearly losses of up to 39%. As represented by the purple bar, bonds have a much narrower performance, ranging from positive 43% to negative 8%. Finally, we see a hypothetical balanced portfolio of 50% stocks and 50% bonds, in which there are lower highs and higher lows. If we follow the performance of these three portfolios during the 5, 10, and 20-year rolling period since 1950, we see the range of returns narrows. In short, a balanced portfolio can help manage overall risk. The precise allocation among different asset classes will vary from one investor to another depending upon their individual goals, time horizon, and risk tolerance. Asset allocation is an approach to help manage investment risk. Asset allocation does not guarantee against investment loss. In this illustration, stocks are represented by the S&P 500 Composite Index, which is an unmanaged index that is considered representative of all an overall U.S. stock market. Bonds are represented by the Strategic Ibbotson Index for the periods from 1950 to 2010 and the Bloomberg Aggregate Index from 2010 to 2020. Index performance is not indicative of past performance of a particular investment. Past performance does not guarantee future results. Individuals cannot invest directly in an index. The return and principal value of stock prices will fluctuate as market conditions change, and shares, when sold, may be worth more or less than their original cost. What can you do in 2022 to move closer to your goals? Here are some action items for you. If your life or personal situation changes, keep us in the loop. We want to hear about important family events like births and deaths. We also care about health issues, employment changes, and any financial developments that may change your situation. And if you find yourself thinking about new goals or reevaluating your priorities, share your thoughts with us so we can help you pursue the life you most desire. On top of specific adjustments in your financial life, we also want to know how you feel about investment changes. These could be details like a shift in your risk tolerance or concerns about the market environment. Finally, remember to go over your estate documents, beneficiary designations, and other paperwork to make sure they're all up to date. A well-organized estate is one of the best gifts that you can give to your family. We're here to talk through whatever financial questions or worries you may have. Our priority is always to help you make informed decisions and choices and to stay on track. Throughout 2022, we will focus on delivering the following. We will keep you informed through regular communication. We'll manage your investments according to your personalized strategy, and we'll stay on top of changes in the market environment and make prudent adjustments where necessary. We've gone through a lot of information here, and I'm sure many of you still have lingering questions. Remember, if you're wondering something, there's an excellent chance that someone else is too. This is where I can help. Please send me an email, give us a call at Northbound Wealth Management. Again, my name is Brent Foster. I'm the founder and CEO of Northbound Wealth Management. Our phone number is 317-399-1107, and you can reach me at bfoster@northboundwealth.com. Thank you, and I look forward to our next time together.